Well, one of the risks highlighted by Reserve Bank Governor Gill Marcus at yesterday's press conference was Europe's debt crisis, with the potential for a double-dip recession in Europe and Greece's economy likely to shrink by as much as 20% over the next few years. Of course, markets have been increasingly volatile due to the problems in southern Europe, with the JSE falling 10% from last month's highs to the levels reached last Friday. Joining me with their perspectives are Tristan Hanson, he's investment strategist at Ashburton, and also Paolo Senatore from RMB Private Bank. Good afternoon, gents. Thanks for coming in. Looking very smart, not doing the Football Friday thing. And Paolo, I'm going to start with you because we have seen this rising market volatility. It's impacting on us. But of course, South Africa is really just a passenger on this ride, isn't it?
It is a passenger in the ride. And I think the reality is we're going to see the volatility. There's a big offshore component in our market at the moment. And just by the movements of their funds, that's going to create volatility. And the other side of the equation, of course, is we sit at a reasonably demanding valuation level, PEs of around 18. So when people get scared, they can drive those PEs down quite quickly, and that brings in the volatility we're seeing.
Well, Tristan, sitting on the other side of the world and looking down at us, how are you viewing South Africa as an investment destination? Because, of course, we have seen massive portfolio flows coming to this country over the past year or so. Are we still attractive to offshore investors?
Well, I'd talk more generally in terms of not just South Africa, but emerging markets in general, in that one thing we're seeing is a reassessment of developed market risks versus emerging market risks. So a lot of these sovereign debt problems are in the Eurozone, the UK, the US, for example, and less so in countries like South Africa and the broader emerging world. Which I think is one reason why the currency is held up at a relatively strong level, supported as well by interest rates versus very low interest rates in the developed world. So broadly, quite well placed, I think.
Do you think our equities are starting to look a little bit expensive this stage?
Well, emerging markets have certainly been the sort of flavour of the month, if you like, over the last year or so. And what we've seen is emerging markets across the board really re-rate to higher valuations versus developed markets than we've seen over the last 10 to 20 years or so. So a lot of that sort of upside versus developed markets is priced in to some extent, I would say. But I actually think there's the bigger issue is there's a lot of pessimism still around developed markets. So I do think there are opportunities there when you look at valuations and what profits growth is coming in.
Paolo, your view on that? Are there opportunities in our market still? What would you be looking at?
In terms of the equity market, there still will be opportunities. I think there's plays within our economy that can still be strong, valuations in the financial sector that still look reasonable. But when you get into some of the resource counters and so forth, if there is a pullback globally, those are typically the counters that are going to have a bit of a setback.
And of course we have seen resources prices coming down a little bit. Those share prices are a little bit under pressure at this stage, and metal's not doing very well apart from gold. And
that's right, because gold will be that safe haven protection at the moment. And the reality is the European condition that we're seeing, Greece, it's now Portugal, and it is significant. I don't think one can underplay the size of this issue. Of course, in that environment, those economies, bear in mind that they're scaling back, upping taxes, cutting spending, will take time to recover. To contribute to the global economy will take time. And we're talking of a number of years before Greece restructures itself, in Portugal and so forth. And from that perspective, the world's not going to have that component. And there's still an element or a part of an investor base that says we haven't seen the end of Europe yet, and it'll carry on. So those are some of the concerns. And once again, I highlight one: when you're trading off a fairly high PE, you're quite comfortable to pull back out of the equity market, and therefore you see these resources coming, considering that they've had such a strong run over the last 18 months or so.
Tristan, Paolo mentioned the financial sector. Some of the stocks there are looking pretty cheap at this stage, and of course we know Nedbank is looking quite cheap. We have some banks perhaps sniffing around. Are you hearing anything in the market? Do you think the South African banks could be vulnerable to offshore takeovers? Would we be attractive to offshore banks?
I'm not really the person to ask on that, because I'm sure you can find people on here with much better insight, including Paolo. I look at things.
Ask him next.
Yeah, I mean, I look at things very much from a top-down macro perspective rather than the sort of bottom-up perspective. But so I'm going to duck that one if I may.
Well, then I'm going to pass that on to Paolo.
Perfectly. I think the South African banking operations, we've seen them come through the whole crisis in quite good shape. And from an international perspective, be it a Standard Chartered or HSBC, who wants to take an emerging market and has a history of a presence in these areas, Africa is still really greenfields, and taking an established play or trying to partner, whichever way, getting into this market, certainly through South Africa, is probably very strategic and very attractive.
Well, Tristan, how are you perhaps adapting your investment strategy at this stage, just given the vulnerability we're seeing in Europe? We don't know what's going to play out there. We don't know if that stability package is going to be enough. How are you positioning yourself at this stage?
Well, I think a few things to highlight. First of all, Greece captures all the headlines currently, the problems in the Eurozone, because potentially they are a very big issue. But I sense at the moment markets are ignoring a lot of good news that's coming through. The IMF's forecasting above trend global growth in spite of weakness in the euro area of 4.2% this year. We've seen industrial production numbers coming out of China and India, double-digit growth there. And profits in the US forecast now to grow 30% year on year, sales forecast to grow 10% year on year in 2010. So I think there's a risk currently that we're focusing excessively on the bad news. Clearly, the Europe problem, if panic escalates, can become a very serious issue. That's why policy is so important to stem the panic. So we've just got to watch this space there. I think the announcements last weekend are very much a positive move in this direction, and bond yields for these peripheral countries have come down a fair bit. But in terms of overall investment strategy currently, we do think, given the volatility and the nervousness in markets, that it's not a great time to be putting a lot of risk on the table just yet. We've increased our cash weightings in our multi-asset funds of late. We had owned some longer dated treasuries as protection. However, I think that play is now sort of played itself out, if you like. So we've scaled back there. And what we'd really be looking for now is more signs, positive signs in terms of a resolution of this problem, and in terms of the Eurozone, and then to sort of be increasing our equity exposure going forwards. Because on a 12-month view, we're still optimistic.
Of course, Paolo, it always just leads back to diversification, doesn't it? And having a diversified portfolio, so you are guarded if things go horribly wrong somewhere.
I think that's correct, and bear in mind, one just takes in the balance of the portfolio with regards to your asset classes, considering there is a new level of risk now and what gains you've just made in the past. So one has to take that into consideration, of course. And I think the other element that, from a South African perspective, one doesn't always have the comfort with is that one needs to potentially diversify into other emerging markets which are showing growth, as opposed to just typically the UK, US, and
Which emerging markets would you be
We're
perhaps
talking
looking
India,
at?
China, Brazil.
India, China, Brazil. Are we still on BRICS here, Tristan?
Yeah, I mean, still very popular. Obviously, the Chinese market is pretty interesting at the moment, given we've seen quite material weakness since July, August time, as they're taking measures to cool the property market. I think potentially that's going to be an opportunity. There's a lot of uncertainty in terms of how that plays out. The quality of the data is poor, etc. But I'm sceptical of some of these arguments that the property market will derail growth in China. I think that the Chinese economy is sufficiently diversified that it should be able to withstand a slowdown there. Nonetheless, it remains a risk in terms of the property sector. But valuations have come back quite a long way. The profits are growing quite strongly. So the fears are sort of dominating the facts, if you like, in terms of the numbers coming through. So I do think there are opportunities in Chinese equities going forwards. India, on a short-term view, the inflation's picking up, so you could see some headwinds from tighter monetary policy there. But on a longer-term perspective, I still believe that the growth potential there remains strong in both those economies.
And Paolo, just quickly, just given the uncertain outlook at the moment, would you maintain a holding in gold or gold ETFs at this stage, just to help cushion you?
Yeah, I think that's probably wise. If you have it, you should probably keep it. And I think the potential for this European volatility and the play between the various currencies is quite confusing. Gold may well still continue to shine a little bit under those conditions.